Hey everyone, welcome to my live stream. It was a good day for stocks this week. We had a positive week for the Dow. We had stocks go up in the Dow for the last 5 days. That's good to see. Good to see. We've had a rough month starting the third week of February into March. It was pretty tough out there. But the Dow for the last 5 days was up slightly. Year to date, the Dow isn't doing too bad. 1.3% is the decrease for the year. Now, has been a good place to wait out this correction. The correction has been pretty tough on growth stocks. It's been tough on stocks that have fundamentals that are pretty stretched. And I mean, like price to sales, you have some companies 30, 40, 50 price to sales. And that's a tough metric, man. It's really expensive metric. You have companies that have PEs that are really high. They're supposed to grow and be exciting businesses. But now with the economy where you have the tariffs, you have a slowing economy, you have stagflation, stocks may not grow as fast as once thought, especially in 2023, 2024, where there was a lot of enthusiasm around AI and that data center. That enthusiasm is kind of leaving the building if it hasn't left already. You have stocks that are now having to be supported by fundamentals, which is always a good idea. If we can weigh the value of these stocks and invest in them for the long haul, we're going to make a lot of money. If we ride these trends, we make a little bit of money in the short term, but it may end up costing us money in the long run if we don't study fundamentals. If we look at the S&P, it did okay for the last 5 days. It was up just slightly. And it's been a rough kind of 45 days when I'm kind of celebrating a win for a week when it's just slightly gone up, but it didn't go down. The S&P year to date is down about 3.6, but when it started the correction, February 19th, it went down 10.13%, officially correcting that S&P. But overall, since that high on February 19th, the S&P is down 7.76%. So it's been a little bit rough out there. It hasn't been too rough. I could see that the market could sell off even more, or it could just, kind of establish a bottom at this point and begin to work for the rest of the year. Certain sectors are doing better than others, and I'll show that in a minute. Now, when it comes to the NASDAQ has been flying high for the last couple of years, but for the last 5 days, it lost a little bit. Year to date, this one has had its biggest correction, or I should say, had the biggest correction of the big indexes. It's down 13.73 from top to the very bottom. And at this point, it's still in correction territory, down 11%. It's come up a little bit, I guess, over the last couple of days, and it's gone up 2.78%. So it's going up a little bit. I think today we saw some big names do well, some big names really rise in value. But so far in 2025, the Magnificent Seven stocks have not been magnificent. They've been really lagging the rest of the market. And by some measures, the small caps have been doing okay. Small caps for the last 2 years haven't done so great. Right now, they're down 7.77% from top to bottom. Let's see, it corrected by 13%. Now, what's misleading is the Russell 2000 is made up of so many companies, and a lot of these companies are not doing so well, and some of them are doing really bad. So they're mixed in with the rest of the Russell 2000, so it keeps this index down. I believe there's a lot of value in small caps, and that's where a lot of money could be made if we evaluate these companies correctly. What do I mean by evaluate correctly or logically is we look at the value of a stock based on the present value of the free cash flows of that business. That's what a business is the net worth of a business is going to be. And I do that by looking at a free cash flow forecast and trying to set up a present value of those free cash flows in today's value. I'll also look at earnings per share, price to sales. I want to look at the balance sheet and make sure that debt is not more than 3 times EBITDA. So a business can pay off their debts in 3 years if they're really pressed. Preferably, I love businesses that have no debt. It really shows that those businesses are really strong. They generate so much cash, they don't have to carry much debt. So the Russell does have a lot of opportunity. And as I go through stocks, we will see a lot of small caps that have been doing quite well. So within the performance for the day, some big names had a good day. Apple had a good day. Microsoft had a good day. Google was up. Meta was up nicely. Netflix was up. Amazon was up. And Tesla had a really good day. Walmart and Costco, especially Costco, had a really good day. So these big names, the bigger the box, that means it has a bigger market cap, has a bigger impact on the overall index. But you see a lot of red out there as well. So it's not a perfect market where everything's working, everything's going up. No, it's certain things are moving, certain things are working. And that's good for the investor that wants to put in the time, effort, and analyze companies and pick the right ones, and also ride the right stocks, pick them up when they're discounted, and then own them for a period of time until the market realizes those companies are really good, and then you make money. When we look at all these companies belong to a sector, and evaluating sectors today, the top sector was communication services. And in communication services, that's where Meta, Google, Netflix, that's where they operate. It was up 0.8%. That was a good day. But for the year, it's down 0.63%. Not too bad considering that like the NASDAQ's down more than 10%. So the communication services had a good day. Over the 5 year, it's had a very good 5 year. And this is a little deceiving because the 5 year, they moved Meta and Google into this sector like a couple years ago. So the compare isn't perfect. Technology had a good day, but it's had a rough year after having an awesome couple of years. Consumer discretionary had a good day. And then some other sectors follow. Materials probably had the worst day of them all. Real estate had a pretty bad day. But materials continues to lead year to date. Materials, due to, I think, tariffs and the expectation that especially like copper prices, gold prices have really appreciated, has made material companies really valuable. So that is interesting that material companies are doing well. Energy is doing well. And then healthcare is doing well year to date. So that's what's working in 2025. And it's a rotation away from what's worked for the last couple of years. You know, technology most definitely worked. I think technology is great to invest in. I've been an investor for the last 20 years in technology. You want to continue to be an investor there. But it's also smart to rotate into things that are going to work for 2025 and 2026. And the market's telling us that, hey, these are the sectors that are now getting more inflows. They have very good fundamentals. When we look at fundamentals in healthcare, especially, you see terrific PE ratios, 10, 12, 14, nice low PEs. And you see great free cash flows. You see really good top line revenue growth, which is very good. And I think the valuations for healthcare stocks are terrific. So I continue to think healthcare is a really good place. And material stocks are a little harder for me to analyze, but I'm beginning to buy into material stocks because, you know, the evidence that they're doing well is very clear. And energy, it's good to have an energy stock or two. In my case, I own Chevron. I'm glad I own it. So that's what's going on with the sectors. Looks like Rico Rocon, very good to see you, man. Hopefully you had a good week with your investments. You want to take a look at ADX, Spanish Renewable Company. Interesting. I haven't heard of that company, so we'll take a look. So ADX. All right, give me a few minutes. I wanted to get through some things, and then we'll take a look at that stock. Okay, so we looked at sectors. We talked about the big caps so far. Apple had a good day, but year to date, it's had a pretty good correction. Microsoft's had a good pullback. Nvidia, correction zone. Amazon, correction zone. Google's probably had the roughest time out of the top five, valuable companies. I think their strategy is a little bit off, and the market's really walked away from Google. It's made the company look pretty discounted, I have to admit, but I think it's deserved. I think their strategy, once again, Google's strategy is being criticized, and investors are moving away from it. Meta is the one stock out of the top 6 stocks that is still in positive territory for the year. Had a good day today. That looks good. And then Berkshire is kind of making it look easy, up 15% in 2025. Good job, Warren Buffett. Broadcom is way deep in the correction zone, and Tesla is way deep in the crash zone. Look at that. They're crash testing this stock, crashing it into a brick wall, and plenty of problems over at Tesla. And the stock's given up a lot of market cap. I don't know that it's going to rally anytime soon, but this one here, it's got to create a couple ulcers in investors because, boy, it was well north of $1 trillion in market cap, and now it's down 38%. What's going to happen next? Who knows? It's a pretty tough stock to follow. Whenever I value Tesla based on their fundamentals, I get a value for the company much lower than its current value. So I just don't know what investors, trade Tesla on. It's probably that, Elon Musk says something interesting and pretty innovating, and then they buy. But, you're buying a story. You're not buying fundamentals, which I think is risky. But that's me. I invest my money. I make money. You guys invest the way you think you ought to make your money. So moving on. So those are the big stocks. So those are the biggies. So in today's live stream, I wanted to take a look at some stocks, and I wanted to take a look at beginning with Nike. Now, Nike had a really bad earnings. I didn't cover this stock in a video, but I did put it on my Discord and as well as on X, that I thought it was a bad earnings. Their revenue went down substantially. Their margins shrunk. You have tariffs that are threatening the Nike business. I mean, there was like no good news. There's no momentum where we're expecting the stock's going to begin to grow its revenue. And here, I think it should have, it's already has the latest quarter. Revenue in the latest quarter contracted by 9%. That's really bad. And the quarter before contracted by 7.7%. And the quarter before 10%. Geez, that's a pretty good contraction. At their high point, Q2 of 2024, this was a $13.4 billion revenue company per quarter. Now they're down to 11.3, right? That's a pretty big drop in revenue per quarter. And I think that's a bad situation. So for this year, the trailing 12 months, it's down 7%. And also what concern is the margins. Gross margins are contracting. That's not good. We want margins to expand. We want a business to get more profitable over time. And Nike is doing the opposite. That's a bad sign. Okay. So Nike's top line, and the top line revenue represents, do customers want to buy Nike shoes? Do fewer customers want to buy their shoes? And, they vote with their wallets. And at this point, fewer customers want to buy Nike shoes, and they don't want to pay as much for them. So double negative. Looking at cash flows, Nike is a decent cash flow producing company, but if they're not growing their top line revenue, I can't do much with that free cash flow. And overall, I put a sell on Nike for myself and have been communicating that to my community. of what I'm doing. Let me show you the valuation that I have for Nike. So Nike, I think, is, you could say, priced fairly, but I actually think it's priced at about a 4% premium. More importantly, I like to think of an investment in a company. I really want to buy into the business. Do I believe in the business? Do I think the business is really desirable? And let me go through a quick little exercise on what I mean by that. So we get to pick from thousands of stocks. We get to pick companies that create pharmaceuticals, and then they have a patent which creates a moat, and then they could sell that drug for a really high margin. Or we can pick companies like software companies like Microsoft that have a really big business of people using their software around the world, really profitable. Then you have businesses like Nike, right? Of course, footwear and apparel. It's an industry and a business that's been around for a long time. Not new at all. And there's very few innovations that are really going to cause the market to really want to refresh, across the board. Yeah, people wear out their shoes and they're going to go buy some new ones. But seldom do you see, oh, that new shoe is so much better, I'm going to pay double. You don't see that. So Nike is a good business, especially their brand, very good brand. The best businesses I put in this green box. These are businesses like Microsoft or a pharmaceutical company like Eli Lilly, just really strong moats, barriers of entry, highly profitable, high cash flow generating. They have a lot of momentum. Their products are exciting. They're growing their top line. They have terrific balance sheets. Nike is cleanly in the gray. It's a good business, but I have to get a very good discount. And I have to believe that the market, the economy, is going to treat them well for the next couple of years. And I actually think Nike is in a bad spot. You have tariffs that could really make their lives much harder if they have to start importing their shoes at a higher cost. If the consumer is right now not paying up for Nike shoes, are they going to be able to raise prices? Maybe not. So they're going to have to shrink their margins even further. It might even cause a loss of units sales, and that's bad. So I think tariffs are a pretty good threat for Nike. They don't have a lot of momentum right now. Also, the economy is slowing down. The consumer is beginning to say, be careful with their spending. They don't want to just spend money like they were spending money 2 years ago, where everybody is getting the stimulus check and spending that freely because it was kind of just given by the government for free. So Nike's a solid business. I think their brand is really strong. I like their brand. I own a bunch of Nike gear. So does everybody else, right? But it's just not a business that's very desirable. It has to be discounted when I buy it. I'm willing to pay, like, for an example, Amazon. Amazon's cleanly in the green. And would I buy Amazon at a fair price? Yes, I would. I would buy Google at a fair price. I'd buy Meta at a fair price. But Nike, you got to give me a really solid discount. And I have to see that in the future, the Nike business is going to do well over the next couple of years. I think maybe in about 2 quarters, the Nike business might be at a point where it's really investable, because we might understand how long these tariffs are going to be in a couple of quarters. We'll also get more information from Nike through 2 additional earnings releases to see how their new strategies may be working better. And if their strategy is working better, then it'd be perfect. Okay, we get this, tariff situation, ironed out, and maybe the governments that are in dispute figure things out. And then we can invest in Nike knowing that they're going to have a couple of good years. So that is Nike. Looking at it top down, looking at fundamentals, making sure that we understand the business. And when you look at, businesses like Nike, there's a lot of people that like Nike, and I can understand why. You have some analysts who are saying, oh, this thing can double in value, or it can, on average, it's supposed to go up 31%. And they're looking at earnings per share. That's not the way that I start with a valuation. I always start with free cash flows. And this could throw an investor off, which is, well, why are all these analysts saying, that the stock is discounted? And these guys are, putting their best, estimate out there. But they are influenced by the fact that this stock was trading much higher previously, well above $90 per share. Now it's down to 67, I guess 68. I think for good reason. The stock should be trading that low. As mentioned in my valuation, they're now trading at fair value. The forward P is still really high, 38 for a business that's contracting. If a business is contracting, I don't want to pay more than 18. Maybe I want to pay 12. Why would I be paying 38? That'd be nuts. So that's a sign that this thing's expensive. They need to correct that by becoming more profitable. And they have to do that by selling more product and expanding their margins. So that is Nike, and it is a sell for me. And it's not in my portfolio, and I won't buy it until probably a quarter or two, or maybe 3, or maybe never buy it. If they can't fix their business, I'm not going to buy it. But I'm optimistic they will. All right, we're 22 strong on the live stream. Rico Rucon. So, yeah, so a lot of hopes and dreams on Tesla. And, I'm a fan of Tesla, and I would say I was a bigger fan like 10, 15 years ago when they were pretty much a kind of a small company trying to make a new business work. But now I think Tesla is a lot of things, and it rubs a lot of people wrong. They're not a popular business to everyone. Their cars are getting vandalized. I mean, there's a lot of conflict there that I'm not going to get into. Rotel and Cheese, what's up, man? Why would Ackman buy Nike beyond my comprehension? Ackman, I think I covered him as a super investor. He's losing money this year, right? So it's not, he's not like undefeated. He's made a lot of investments that have lost money. Nike, he'll have to explain why he bought Nike, but he's not in my opinion, he's not the most successful super investor, not even close. The probably the most successful super investor for 2025 that I've researched and analyzed closely is Pat Dorsey. That guy's killing it. And a couple of others are also killing it. Warren Buffett's doing great. But Ackman, man, he's losing a lot of money. So he bought Nike. All right, I guess he wants to lose a little more money. Magical Self. Thoughts on Upwork and Now. Yeah, we can take a look at those. All right, got those noted. Let me keep rolling on it. A couple more than I wanted to look at. Now, I live in Southern California, and this morning I had to drive to pick something up, and I went past the headquarters of Viant, and this is a smaller business. It's less than $1 billion market cap. And you can see that this stock really went up and really came down. What do these guys do? Viant Technology operates as an advertising technology company. It provides Viant AI, a suite of artificial intelligence products, holistic, omni-channel DSP, an integrated platform that manage omni-channel campaigns across metrics. So these guys are helping businesses that are advertising online, which, as you can probably tell on YouTube, advertisers advertise on YouTube, Facebook, across all the different media. And even now Netflix has a advertising option. Amazon has their video. They have advertising on that. It's very precise because as people stream, right, the software can really pinpoint where they're located, and a business can really focus geographically, and the right prospect is targeted. So all this stuff's really good. Viant is a smaller version of AppLovin, and AppLovin's been crushing it. So I'm going to show AppLovin just real quickly. These guys have been doing really well, up 345. They also had a rise and then a fall, but they've been rallying over the last couple of trading days. My interest is Viant a really good opportunity? Because you could see that their stock isn't too far up above where it's been for the last year. It did have this really strong rally that caused the stock to double in value, and then it came back down to the value it had in the October timeframe. Let's take a look. It's a small cap under $1 billion. You're paying roughly 3 times sales. That's really low. It's very good. Forward P of 22.5. Okay. And when we look at their growth, good growth, almost 30%. Let's take a look at the quarterly. The quarterly is showing us that they're actually accelerating their growth. That looks really good. So accelerating growth, good growth at 30%. It's a small cap. Looks good. Do they produce free cash flow? They absolutely do. $49 million of free cash flow. Good gross margins, and you're going to see these margins expand as they get bigger. As they get bigger, they could then spread some fixed costs across more revenue, and their margins expand. That's what I want to see. As this business gets bigger, it becomes more profitable. That's very good. So this stock here, let's take a look at their balance sheet before I start doing a back of a napkin quick assessment to see if they're discounted. So their balance sheet is, they have $205 million of cash, only $26 million of debt. Very strong business. This is what I mean when we look at businesses that have a lot of debt, that shows weakness. When we see a business that has a lot of cash, that shows strength. I don't think I need to convince anybody. It's just like at home. If you had $500,000 in the bank cash, you feel pretty strong. If you have $500,000 of debt, you're feeling a little vulnerable. Well, businesses are the same way. If you have a bunch of cash on your balance sheet, you're feeling pretty strong. So this business is pretty strong. Got about $179 million of cash on the balance sheet. 49 million. I'm going to multiply it times 30. That gets me to roughly $1.5 billion of market cap value. And this thing's priced at 787. So I think that Viant might be a nice discounted stock. So let's take a look at, see if I already got a valuation for Viant. I thought I did. All right. So here's Viant. And when I value the company, I use a higher discount rate. I use trailing 12 months plus growth. And that growth might be a little too conservative, but what the heck? Let's just leave it there. And just based on free cash flows, this stock's actually worth 98% more than the value of their cash flows. So they're in an interesting industry. They're showing really good growth, strong balance sheet. They're in the right space. We've seen AppLovin really, really flourish. So I'm liking Viant, and I'm thinking I've been watching this stock for probably about a month. And I'm thinking I should start buying shares because the buying is good. When we look at the stock itself, over the last year, this thing really just jumped up from the October timeframe, and it hit a peak in the second week of February 12th. It went up 133% over the course of 3-4 months. I mean, that's just too much, too fast, right? And then it really corrected, but you saw the fundamentals. They're growing the business. They're profitable. They generate free cash. They have a lot of cash on the balance sheet, and they came down 52%. Well, this is the market knocking on my door saying, here's an opportunity to pick up a really neat little business that is a tiny cap, less than $1 billion in market cap in an exciting industry. For all I know, these guys are going to get acquired. I mean, they can get acquired by AppLovin or some other bigger software company that wants their niche of what they do for marketers. This is totally an acquisition play for like an Adobe, a Salesforce, a ServiceNow, somebody that wants this piece or this particular IP category. This would be a really good acquisition. So this is going to be on my list of stocks that I want to think about buying next week, which tells me I should go to my watch list. Let's find Viant. And I got to change this sucker to, and I don't even know what the symbol is. Give me a second here. There we go. So the symbols throws me off because it's Viant Technology and DSP is the symbol. So I'm going to put a buy on Viant, and I'm going to look to buy this stock next week. I think it's a good opportunity. What's good about these corrections, right, is you have a correcting market and it really corrects. It's not like every stock gets the same percentage, decrement to its stock price. Usually small caps get punished even harder because investors are not as comfortable with these lesser known names. So when the market discounts a stock like this, and I showed that this thing's growing, all the right fundamentals, it's an opportunity. It's a really nice opportunity. So that is Viant. I was driving this morning, actually going to pick up something that we needed at home, and I drove past their office. It's in Irvine, California, and I'm glad that I took a look at the stock. I think it's a good opportunity. So that is Viant. All right, so let's keep rolling here. I think I've talked enough about my stocks. I still have a couple more, but let me get into some of the stocks you guys want to take a look at. And let me catch up on comments here. So Magical Self, I noted we got Upwork on the list. We got ServiceNow on the list. And then Magical Self, I am interested in your thoughts on how you decide when to sell a stock that you've been holding for years. Yeah. So I'm going to cover that. That's a very good topic. I'm glad you brought it up. Rotel and Cheese. TTD is the leader in digital advertising space. All right, let's take a look at TTD. Why is that not like ringing a bell for me? TTD, Trade Desk? TTD? Are you sure it's TTD, Trade Desk? I don't know. Oh, okay. All right. I think you're right. So the Trade Desk operates as a technology company in the United States and internationally. The company offers self-service cloud-based ad buying platform that allows buyers to plan, manage, optimize, and measure data-driven digital advertising. Okay, cool. For some reason, with a name like this, the Trade Desk, I thought they were like a brokerage. To me, it sounds like a brokerage business. No, but you're right. Look at this. Well, thanks for bringing this up. Let's take a quick look and see what the heck's going on here with the Trade Desk. So these guys are 28 billion. They're not quite as big as AppLovin, right? Let's take a look at the revenue. Revenue looks really good. That looks really good. Look at this growth. Beautiful growth. Gross profit has been expanding. Very good. We'll look at the gross profit percentage in a bit. Free cash flow looks stupendous. 641 million with revenue growing at 25%. That's what I'm talking about. That looks great. So we got high free cash flow. You got a very profitable business, 80% profit margins. Forget you, Nike, with your 40% margins. Get out of the way. This business, 80% margins. That's what I'm talking about right there. This is a more valuable business. Just when you sell a piece of intellectual property like software, you're not having to put in materials and manufacture stuff. You're just selling a copy of an intellectual property or a service, a software service at a very low cost. So that's where the margin shows up. So that looks terrific. So this business is really valuable. Again, their free cash flow is 641. Let me just take a peek at the balance sheet. I'm expecting they're going to have a cash balance, almost 2 billion of cash, 300 million of debt. So they have 1.6 billion on the balance sheet in the bank, ready to grow the business. No problem. They can put more capital into the business if they have really good ideas. Go chase them down. Keep growing the business. Based on that figure, this business, the 650 or so of free cash flow, if I were to multiply that times 30, I get to about $20 billion of free cash, of market cap value plus 1.6 billion. So I get up to about $22 billion of market cap value. And that's below the $28 billion. Part of that might be that over the last 5 years, this stock has really worked. And the stock's already been priced quite high. Okay. So I'm not excited about this stock because it's already priced quite high. The other factor is you're paying roughly you're paying 11, about 11 or 12 times sales. I like to stay under 10. So if I go 2.44 billion, multiply it times 10, I get to 24.4. And then you add another 1 or 2 and you get up to the 28 billion, right? So that's where I get 11 to 12 times sales. That's a little expensive. All right. Now, AppLovin, I could tell you I valued AppLovin. I valued Viant, which I showed you. And AppLovin does have a small discount, but AppLovin as well is a stock that has a discount, but not a really good discount. A 1% discount overall, not very good. I actually bought AppLovin when it had this crazy crash recently, and I made a quick like 12 or 14% in like 4 days. Then I got out of it because I'm like, it's just not discounted enough. And this stock's just moving too much. It crashed hard. It went from 510 down to 252. It was down 50% in 3 weeks. Just incredible drop. And I put a buy order with a super low price. I just thought, man, if it gets down to that level, I'll just have, these shares bought, and it bought the shares, and it bought them on a Monday, and the stock really flourished very quickly. I sold the shares. I'm like, all right, this stock's just moving too much. And my valuation of the stock is, it's not very well discounted. I do like the discount here. And when we look at AppLovin, where it's been, I'm going to put DSP in here. And then I'm going to put Trade Desk, right? So Trade Desk. And we'll track these for the year to date. Actually, we'll go 1 year. So you can see that AppLovin's kind of leading the charge there. For the 1 year, it's gone up the most in price. So obviously, AppLovin was the stock to buy a year ago. It's crushed it. Trade Desk's done a little bit poorly, down 33.8. Viant's been okay, up 20%, but it's not up this crazy amount that AppLovin is. Year to date, AppLovin hasn't given up much of its gains year to date, but Viant has. And Viant wasn't all priced up. Trade Desk, I just showed that I think it's priced a little too high to begin with. So I think Viant's the best option. Again, I want to buy a company that is doing really well, growing really well, but I want to buy it at a really good discount. Viant's less than $1 billion in market cap, where AppLovin is at a much higher market cap. And that one, for it to go up very fast, it's going to be harder. And let me put in, what is the market cap on AppLovin? It is $107 billion in market cap. So that's a pretty big market cap. This one's less than 1 billion, 107 billion. This one's 28 billion. So this guy here can double very quickly. Boom. It could also be acquired. And when they get acquired, the acquirer will pay a nice premium on it. So a lot of things look good for Viant. I'm really liking everything I'm looking at for Viant. Thanks for bringing up TDD, Rotel and Cheese, bringing good knowledge to the live stream. Liam Bell, I've got about 80 grand in ISRG. Is that Intuitive Surgical? Cost basis is $9K. Nicely done. You know, I evaluated, and I'll talk about it a little bit later, but I did evaluate Intuitive Surgical last week. So the company's fresh on my mind. Yeah, I'm glad you're in the stock. Looks good. Prashant Mishra, Virgin Galactic Space. Take a look at that. I think that one's a little bit of a dumpster fire. We'll take a look. Moatwise, hello, man. Good to see you. Thanks for joining. Appreciate it. Cool. Yeah, we're going to talk about when to sell a stock, and I'll get to that, Liam. So I got 35 people on the live stream. Thanks so much. Let me just go over what this channel's about, and then I'm going to keep rolling. We're looking at stocks that viewers are looking for me to analyze. I'm a long-term investor. I look at discounted free cash flows. That is the method that a lot of successful investors, Warren Buffett, Charlie Munger, you look at Pat Dorsey, investors that have made a lot of money over time. That's my strategy in finding businesses that are discounted. So as we look at these stocks, I'm going to try to get to fundamentals that show me the weight of the value, weighing the value of that business and trying to see where the fundamentals put that stock. Is it discounted or is it priced at a premium? And we'll look at other aspects too that give us a sense of the desirability of a business. Does it have a strong moat? Does it have good momentum? Is it growing its top line? What are you paying price to sales? Those are the metrics that count. If you want to be successful over the long term, buy quality businesses that are discounted, own them for a long time, triple, quadruple, 5x your money, 10x your money, and you'll become very wealthy over time. So that's what we're doing here. Let's get into the list of stocks here. So we're going to go into ADX. ADX. And I know I've got a lot of viewers. So if you have a stock you want to take a look at, put it in the chat. We'll take a look at it. So this is Adams Diversified Equity Fund. Adams Diversified Equity Fund is a publicly owned investment manager, primarily provides its services to investment companies. The firm is a large advisory firm. The firm is actively engaged in businesses, including commodity pool operator, commodity trading advisor. So this is like private equity, right? You're giving them money and then they are investing that money. Now, these firms have been having a tough year because the stock market's been losing a lot of value. So these guys tend to make investments in other businesses that are privately held. And the reason why their stocks are going down is they bought into businesses and it's going to be harder for them to have an exit strategy in that business because the stock market itself is selling off. So this particular firm, BlackRock, a lot of these firms that are in this particular space, you can see all their stocks have gone down for 2025. Is it going to get better? I don't know. I think the situation's a little tough. You have an economy that's slowing down. You have tariffs. You have potentially a recession that's going to happen. So there's a lot of things that are not stimulating growth. You have unemployment is going up. People are losing jobs. So having said that, this is a space that I've never really liked because rather than giving people money to invest, I'm the investor. I like to do my homework on companies. I like to buy Robinhood when it was really low. I like to see that my money's, 4x'd very quickly. I can make those decisions. Why would I just give money to somebody else? Maybe other investors are prefer to invest that way, but not me. I'd rather buy the companies or the bonds or the crypto or the real estate, make a good decision, and then I benefit from the gains. So this isn't the right business for me. And it's been kind of a rough part of the market. Most of these businesses haven't done well. When you look at this business, you have a $2.25 billion market cap. You only have about 35 million in revenue. So that's many times revenue. You'd be up, like I guess around 70 times revenue. That's really high. But the P ratio is 4. How is that? This is more like an ETF mutual fund is what you're investing in here. They have a very high dividend rate because they're investing in these they're investing in commodity pools and so forth. Yeah, interesting. I mean, I could understand people chasing this dividend. It looks really attractive. I can't give you a value because it's not a business. It's just commodity prices have gone up and these guys are benefiting from it. But overall, the stock is down 15% over the year to date. So yeah, you get a nice dividend, but you may lose some of your investment. And over the course of 1 year, the stock itself didn't appreciate. I'd rather get stock appreciation. Dividends are cool, but the number one goal is I want my stock to go up in value. So thanks for asking about that. It's not my strong suit on, talking about stocks like that because they really are more of a ETF mutual fund, but good luck with that. All right. Next one up is Upwork. And Upwork is a stock that I know I have a valuation on. And there's a lot of things I like about the Upwork business. Year to date, it's down 17%. This is a smaller cap, $1.8 billion market cap. Its revenue is $7.7 million. So you're only paying like 2.5 times revenue for a really interesting business. Forward PE of 12, really nice and low. And analysts think it's a buy. When we look at this business, it's growing okay. That's one thing that I don't like about Upwork is they're a small business, but they're not growing really fast. It's like, guys, you got to grow faster. But what Upwork does is you have people that are doing gigs, right? They don't have, maybe they do have a full-time job, but they're willing to do side hustles. They're willing to do some project work, and businesses can go on this particular platform and find people that can do particular assignments. Like, hey, I'm going to get a developer to write some code, or I'm going to hire somebody to do certain things. And you can hire people to do that, and people will get reviewed on it. And then people can keep themselves busy doing gigs on Upwork. I think the model is a good one. It's like Uber or it's like Airbnb, where it's kind of like you can find people to do these gigs. I like that business. But what is concerning is you have a business that's not growing fast enough. I think they should be growing at like 30, 40, 50% because there's probably a big addressable market, especially as you find people. Let's say you're in the United States and you can find somebody who can do the work somewhere else in the world. And you can probably get a really nice, cost advantage. That definitely is an opportunity. So they should be growing faster. That is one of the concerns that I have there. Other things that I like about the business is that they do produce free cash flow, and they have grown their cash flow really nicely. It's really jumped up $150 million of free cash flow. And when we look at their margins, gross margins, nice high gross margins, 77%. And those are going to grow. See how they've grown as they've gotten bigger. That's going to continue to grow. As they get bigger, they get to make more money with the same platform that they bought once. So that's going to continue to grow. So looking at that free cash flow, looking at all those fundamentals, I have a valuation on Upwork because it's a stock that I think it's a neat company. So I started to really track it. I think it's discounted nicely. On free cash flow, it's discounted by 99%. And overall, when I include a valuation based on earnings per share, which I influence the overall value by 1/3, it's an 85% discount. So this stock looks really good. Now, what happens when you have these corrections, again, I'm going to be a little bit of a broken record there, is the market will sell off these businesses that are new and maybe are not as comfortable. Early in the video, I showed you how Dow-based stocks have been doing okay. And the reason for that is those are really well-known stocks. McDonald's, Chevron, they've been around forever. So investors are comfortable there, especially in bad times. But these small businesses, they're not so comfortable with. So they sell them off. Even though they're really good businesses, they sell them off. This really worked. Man, look at this jump. My only complaint is in the latter part of 2024, when the election happened, everything went berserk to the upside. Now, it was fun to watch stocks go up on my portfolio. I have to admit that. But it just went berserk. And then you look at the high and it really sold off. This thing sold off, 29%. So this stock's looking good. Upwork is going to be in my portfolio. This thing is a good business. I'd like to see them grow a little faster. Maybe give them a quarter or two to get their act together around growth. Or if growth goes down, I'm going to stay away from it. Like, why the heck aren't you growing? You're in a really organic, fertile area. This should be growing much faster. Why are you not growing so much, faster? So I like the Upwork business. I think it's discounted. Might be a little early to invest for me. I'm giving it a little bit of time, letting it kind of begin to pick up momentum to the upside. And I'd like to see another earnings to see if they can begin to grow a little bit faster, because I think that is important to see in the stock. Their next earnings is going to be on April 30th. So we are about a month and a week away from that event. And I think that might give us, if they start growing much faster, I think I'll probably be a buyer after those earnings, because I'll be excited about, hey, this is a really neat business. I think this business fits the times. I think it'll continue to grow. And you just think about the international aspects where you can have a business in, Brazil wanting to hire people, and they hire people around the world, in the United States or in China or in India, and you hire people to do work. Or I should say, to do project work, to get certain tasks done. So I think this has tremendous opportunity to the upside. So that is Upwork. Hopefully you found that interesting. All right. Somebody asked about ServiceNow. And ServiceNow was overpriced for a while. Let's see if they've come back down to earth. And I'll tell you why I thought they were overpriced. So right now, over the 1 year, they're up 8%. Over the 5 year, they're up 224%. When we look at their market cap, 170 million, right? You're paying, this is an 11 billion revenue amount. So you're paying about 16 times revenue. That's a little expensive. And ServiceNow, its main competitor is Salesforce, symbol CRM. Now, Salesforce is bigger, stronger, more profitable. And that's my biggest worry about ServiceNow, is these guys are kind of a one-trick pony. They focus really on the service aspects of a company's functionality. And ServiceNow does do it really well, but I think they just become too expensive, especially this run. They started to really talk about AI, and their stock pretty much doubled in value. But the reality is AI apps are not really catching on. AI was a gimmick. AI was a gimmick in 2023 and 2024. ServiceNow was a big beneficiary because they were going big on AI. Oh, we're going to do everything AI. Well, if you look at the realities of AI, it's not really catching on. So I think that ServiceNow is going to come back down to earth. That's my opinion on it. And it is expensive. I think I said it was 16 times sales that you're buying the company for. That's a little bit high. Forward PE 50. That's definitely high. A forward PE of 50. And the current year PE is 121. Very high. Revenue. The growth is not that exciting. If we look at Salesforce, you can see that Salesforce is much bigger and they have good revenue growth. So this is a $38 billion revenue company. ServiceNow was 11 billion. So Salesforce is 3.5 times bigger, and their market cap is 270. So you're paying 8 times, about 8 times revenue. So you get a better value if you look at the total sales. Forward P is 25 versus ServiceNow 50. So you're getting Salesforce for half the PE of ServiceNow. All right, so let's keep looking. So the revenue growth is 22%. Salesforce is bigger, a bigger company. They're growing at 9%. But this is a much bigger revenue number. You'll see that ServiceNow, as they get bigger, it gets harder to grow. Looking at the quarterly, you can see the percentages go down. Now, I think the gimmicky part of their AI thing is going to catch up with them, and I think their revenue is going to begin to suffer. When we look at their free cash flow, they're producing $3.4 billion of free cash flow. They are growing well. So if I gave them a generous, let's multiply this times like 25, we'd get to about $90 billion in value. And these guys are at 170 billion. So they're just priced way too high, in my opinion. And I think ServiceNow, I would not be surprised if this thing is priced, the stock price comes down to like $400 a share. It'll be a little bit of pain and suffering for investors, because this stock really, as recent as January 2023, was a $366 stock. It just took off because they started saying, oh, we're going to be an all AI company and this, that, and the other. It was a gimmick. It was a marketing message. And once we realized that, hey, most of their software services are really around their traditional business, there's really no AI lift here. So we'll see how things play out. But my expectation is that this is just expensive. It's an expensive stock, and it's going to come back down to earth. So that's ServiceNow. Now, somebody asked if, when do you sell? And I think it was asked, 2 different ways. And I would say that buying a stock, making the decision to buy a stock is oftentimes far easier than making a decision to sell a stock. And I'll put a couple scenarios out there. First, somebody brought up that, hey, they're sitting on a really nice gain of, I think, Intuitive Surgical. Now, if you're looking at a stock, and I'll show Robinhood as an example. I'm sitting on a terrific gain of Robinhood. Okay. And now I still think Robinhood is really nicely discounted. I've doubled or tripled my money on Robinhood. I'm not selling my shares. I'm just going to keep riding Robinhood because it's still discounted, in my opinion. They're a very, very good business that keeps growing the number of customers they have. It keeps growing the cash flow they produce. All the right things are there. Done. Now, another example would be Taiwan Semiconductor. I tripled my money on that stock. I felt like the stock price had gotten too high, and I was seeing negative numbers, and I don't have Taiwan Semiconductor right now as an analysis stock yet, or still. I decided to sell that stock because it got well past my intrinsic value calculation, and I made the decision to sell Taiwan Semiconductor. That was a good decision. So I think that my thoughts are that once a stock gets more expensive than its intrinsic value, if I don't believe that their story or their strategy is going to expand the company in the future big enough to meet that stock price, then at a minimum, I'd be selling some of my shares, 25% of the shares, 50% of the shares, and take some money off the table. If the stock gets really crazy, sell all the shares. So that's my way of operating on selling shares. I also sell like those are positive, like, hey, you made a lot of money situations. Then you have situations where a stock is going down in value. I oftentimes see comments where somebody's sitting on like an 80% loss and they've never got out. Well, again, you think about the first decisions I make when I look at a business. I think we talked about Salesforce. I really know the Salesforce business. I've worked in this industry for a long time. I know Salesforce. I understand them. I know when I think they're discounted, and I know that they're going to be a bigger business in the future. Now, if that were to change, and I think they're actually faltering and they become a bad business, I would sell the stock. It has to start with, I believe in the business. Now, you talked about somebody talked about Intuitive Surgical. I think Intuitive Surgical is a terrific business, but it's just gotten so damn expensive. 275% rate of appreciation. Congratulations. Nicely done. And I think you're sitting on even a higher gain. I think you bought way down here, right? So you're sitting on an awesome gain. Congratulations. Now, I think Intuitive Surgical is priced well above its intrinsic value. A couple of things that I'm uncomfortable with is revenue. You're looking at a stock that's selling for more than 20 times sales. That's expensive. 10 times is when you buy a business at 10 times sales, that's expensive. Let me give you an example. We all love Meta, right? At least most people love Meta. And you have this terrific business. Look at this growth, 22% on a massive number, $164 billion. You look at their cash flow, it's freaking nuts how much cash flow they produce. This is such an awesome business. You're buying it less than 10 times sales. So why am I paying more for other businesses? They're not like the gold standard, which is Meta or Google or one of these awesome businesses. Why would I pay more than 10 times sales if I could just buy more Meta stock? So why buy Intuitive Surgical at over 20 times sales? That's first red flag. Forward PE, 61. Forward PE. Current year PE, 76. Again, Meta, 23, 25. I showed you their numbers. Why am I paying these numbers for this stock? Again, AI strikes again. These guys have a Da Vinci surgical system. This is tied to hey, are we going to be able to do remote operations? Is AI going to get in the mix? And long and the short of it is, I think Intuitive Surgical is a quality business. It's just super overpriced. If I owned Intuitive Surgical, I would have sold. Okay. But that's what I would have done. And I never provide financial advice, and I never tell anybody to buy, hold, or sell any stock. I'm just sharing what I would do. And that's what I would do with Intuitive Surgical, because they've exceeded their intrinsic value by a pretty good margin. When we look at their revenue isn't even as good as Meta, but Meta gives you better fundamentals. Does anybody doubt Meta is going to keep growing? It's pretty tough to imagine that's not going to be the case. And they have really good businesses that are coming. The quarterly looks good for Intuitive Surgical, but I think investors are beginning to look at the fundamentals and reassessing the stock and selling out of it and saying, you know what? It's had a terrific run, but now the stock from its recent peak to now, it's down 19%. I wouldn't be surprised if this thing stays at this price and continues to sell off, maybe trades at $300 a share or so, because it is really overpriced. If you look at these fundamentals, they just stick out like a sore thumb. So the fundamentals tell me this business is just priced much too high. It's been a successful business. Oftentimes you get these businesses, it starts with a very good business, but it just gets way too expensive. And selling's oftentimes hard because This has been an absolute winner for somebody. When do you sell? Right? That's, the great Warren Buffett's been selling out of Apple. He decided to sell a big winner. And he's also sold out of some losers. He sold out of, I think it was Ulta, and he sold out of Paramount, and those are big losers. Not to the extent of Apple, because Apple was such a big investment for them and it's such a big winner. So those are the comments I would have on when to sell. Is it has to be a combination of qualitatively, you have to make a decision. Do I still like that business? Do I think that business is really strong, or do I think it's gotten weaker? And the fundamentals look too expensive. Could I buy a different stock that has just a better value proposition to me, a better risk to reward ratio? And Intuitive Surgical, as an example, this has a lot of risk. Can it go up even higher? Well, I guess we'd have to go up to 100 PE, forward PE. Whoa, that's a high PE. And the revenue isn't all that exciting, the revenue growth, right? The revenue growth is good, but the stock's so damn expensive, it's already priced really high. So those are my comments there. All right, so I see some other people joined. Mike, the dividend investor guy. How are you? So you want to look at OGN. I think is it Organon? And then GCT. Glad to do it. Cool. I'll take a look at that. And Liam, you want to look at CRM and Adobe. So I talked about CRM briefly. I can hit Adobe. Those are quick because I cover those regularly. So Reddit, Reddit, it's obviously a lot of people know Reddit, but it's had a really tough last 30, 60 days. Magical Self, would you sell Apple after holding it for 10 years? Yes. I think Apple doesn't have a lot to offer. Okay. All right. So Mike, you want to look at OGN and GCT. So OGN, Organon. So Organon, I think, was a spinoff from, was it Merck? It was from one of the pharmaceutical companies, spun them off. I think these guys focus on women's health. They're a drug manufacturer, healthcare, and they focus on women's health. And I think it was Merck or one of those companies. Now these guys, let's take a look at their revenue. I think that's where we had a little bit of trouble. So they had some contracting years, but it looks like revenue is growing a little up and down, but it's kind of a slow grower overall. You have low single digit growth. You have free cash flow looks good. $764 million of free cash flow. Margins look okay, 58%. Okay, so if we're dealing with 764 slow growth, right? So let's look at their debt. So they have about $8 billion of debt. They're about a $760 million free cash flow company. They're not growing very fast. So maybe I give it, it's just not a good valuation for me because I'm stretching to try to get to 8 billion. And then I fall right back down because they have $8 billion of debt. So I get close to zero on my valuation techniques, and they're priced at 4 billion. So for me, that's why the PE is so darn low, is they have a lot of debt, and I wonder what it is, debt to EBITDA. Debt to EBITDA 5. Yeah. I couldn't touch this business. Too much debt. Somebody else can invest in it. Yeah, that dividend, right? They lure in investors. Look at this nice dividend, 7%. That debt is the devil. I do not want debt. These guys are on the hook. They're going to be somewhat slaves to that debt. Let's take a look at their interest expense. So you have interest expense, $520 million every year. They have to pay that. That's about 8-9% of their top line revenue. 8 to 9% of the company's revenue is just going to debt. That's a lot, man. It'd take them 5 years to pay off that debt. It's too high, way too high. So it's not a desirable business for me. I would stay out of Organon. Is one of the investments that I would, or decisions I would make. Now let's talk about GCT. So GCT is GigaCloud Technology, and these guys do the fulfillment of large products that are bought over e-commerce. I did something today that, was super convenient. We have 2 cars at home. One's a brand new, really nice car. And then another one is an older car that we kind of kick around and don't drive it as much. Well, that car, its battery was bad. So I just ordered it online. Somebody came, replaced the battery in my driveway. It was super convenient. So that's where the world is. And these guys do something similar, which is when you buy a big product, you buy a couch or something, these guys will deliver that type of product. And you can't put big items like that on UPS, FedEx, because they can only handle certain size packages. And these guys do that. Their business has been growing, 65% for the full year, 20% in the most recent quarter. So that slowdown is telling us that the economy is slowing down for these big discretionary items that are being bought as the consumers are beginning to conserve their money because, hey, the economy's not doing great. I think that's really affecting these guys. So I'd be a little concerned that their business is going to have a hard time growing, but they are small. And I think all the other fundamentals show that this business is just doing quite well. $600 million business, super low PE. I think they have very little debt. Let's take a look. Yeah, they have $300 million in cash, $484 million in debt. So they really have net debt of $181 million. Debt to EBITDA is 2. When we look at their free cash flow, it's grown nicely, nice growth. And I think I do have a valuation for these guys. And I think they're discounted. Now, what's hard about this business is it's got a really nice discount. The business makes sense, but there's so little that the market just doesn't really recognize them. When will it rally, right? And they're not in an exciting category. And you see that over the 1 year, they're really down. They're kind of unknown. The market just doesn't show them any love. That's my apprehension is when is the market going to show these guys love? I don't know. There's other options out there that I think are pretty exciting. Like we saw Viant. We've seen other businesses that look pretty neat. This one, I have to be the first to say this is a discounted business. But when will it rally? I don't know. And I am seeing that there's a contraction in revenue. I think I showed you in the most recent quarter. And that makes sense based on where the economy is, right? The economy is slowing down. People are being careful with their spend on large ticket items. Well, these guys are a large ticket item industry. When somebody buys a big product online, they usually have GigaCloud deliver it. So this one here, I think it's not going to do much for the next quarter or two. Once we see that maybe, and then the tariffs, right? Tariffs are probably going to affect these guys because they're probably delivering a lot of products made over in China. So I think that could also be a headwind. And once we get through that tariff kind of, time when the tariffs are kind of active and the arguments are happening, we get past that, we get to a growing economy. I could totally see this stock really working. So for now, I'm going to stay away from it. I just don't think that it's setting up to do well in 2025. And I'm going to stay away from it and maybe just keep an eye on it because if we do get to a growth period, I wouldn't mind buying into this. Now, I do believe that these guys, although they get listed as a software technology company, I actually think of these guys as more than an industrial compared to like a UPS or a FedEx, which those guys belong in the industrial sector. So that's my comment on GCT. I'm just not sold. There's a lot of opportunity out there right now. What's good about a correcting market is it now gives me very good prices on stocks. I can go buy some really terrific stocks that are out there. And I don't need to buy, 100 different stocks. I can buy a solid list of stocks that I believe in and then just watch them rally. I'm mostly excited in healthcare right now. I think the healthcare sector has great fundamentals. It's working, like it. I'm excited about China. I love BABA stock. I'm buying into Futu. I'm also buying into an ETF. So my portfolio is doing well. I need to avoid getting overexposed on some stocks that are just not going to work. And GCT, I'm afraid, is just not going to work. So good luck with that. Thanks for tuning in, Mike. I've only been able to live stream a couple of times this week, and I appreciate you joining. All right. So I think let me catch up on comments. I'm going to talk about CRM and Adobe in a bit so I can answer questions that are coming up on Salesforce. Junior Pacheco, how are you, man? And just out of curiosity, I'm a software engineer, and you said you also worked in the industry. What are the main elements you analyze in software business? So I'm going to talk about that. And okay, so I could talk about that in a bit. Let me just make sure. So software businesses. I'm going to tell you why software businesses are so attractive. Neil, how are you? Good to see you, man. Mike, the dividend investor guy. Yep. So debt, man. Debt is the devil. Junior Pacheco, you're a beginner investor. Very good. You're asking a very good question there. I'm going to get to your comment on software industry, and I'm going to get to that comment you just made. And then Simo E. Does it make sense to buy into Block if you're already a PayPal investor? Well, let's talk about those. I'm going to put it on the list. We'll come back to it. I'm a PayPal investor, and I'm very familiar with Block. And I'll tell you why I'm an investor in PayPal and not Block. Cool. Thanks. Good to see you, Mike. Thanks for showing up. All right. So we're going to hit Reddit. I'm going to talk about the software business and answer your second question, Junior, on, what you should be investing as a new investor. You're asking a very good question. So hang tight, because I think you're tipping on one of the advantages you're going to have. All right. So let's keep rolling here. Jay Zeb, I'm doing well, sir. Good to see you. Why do I believe in crypto? Bear light. Man, that's like, it's almost asking a religious question. All kidding aside, I'll tell you why. I will tell you why, man. What's up, DZ Divs 32? What's up, man? Good to see you. Very good to see you. And then JZEV TSM. We can talk TSM, Taiwan Semiconductor. So we left off on space, symbol space. And now I never bought into the space economy because so many things can go wrong. Here's a perfect example. Virgin Galactic. These guys were supposed to do space tourism. And it was kind of dead on arrival when I looked at this business, because I'm like, I'm sure there's a couple people that are like, I'd love to go up into space. And these guys get to travel into space for a few minutes. It's not like you're up there for a week at a space station. You can just go up there and then you come down. The risk is really high. In fact, Virgin Galactic, in their testing of the spaceship that they put together, One of their test pilots lost his life. When you travel into space, you are up there. Something happens, a bad thing happens, people are going to die. So that's just really risky. Now, I thought qualitatively, big picture, how many people are going to want to travel in space? I didn't think it was very high. I'm thinking, I'd rather go into a beautiful forest, hike around for a week. I just took a week off and I did a lot of hiking and walking and hanging out somewhere where it was, open, country. That's a vacation. Going into space is an adventure, I have to admit, pretty cool. I'm sure there's a couple of people that want to do it. I just didn't think it was going to have like a big, addressable market. The stock has really crashed and cratered. I just don't get what investors were thinking when they were buying into the stock. The stock was worth over $1,000 and now it's $4.10. I would not touch this stock. I would not. This is not going to do well. Look at the revenue. It's never gotten like a consistent revenue stream. You're paying, even though the stock is down like 98%, you're still paying like 200. Is it 200 times? Let's see. 10, 7. No, you're paying more than 20 times revenue. Even though the stock's way down, they're losing a bunch of money. They don't have a P because they're losing a bunch of money. This is like a dumpster fire. Me personally, I'd stay away from it. I'm like, I don't believe in the space. It's dead on arrival. Would somebody buy their assets? I don't know. Maybe. But if you're buying into a stock because they're going to have an asset sale when they go bankrupt, I think you can make a lot more money finding awesome businesses that are going to grow and flourish. Like the investor on this live stream that bought Intuitive Surgical early made a ton of money. I think he invested less than 10 grand. He's up like 80, 90 grand. Beautiful. That's the investment we got to look for. We can't go dumpster diving into some of these stocks that just are, on fire. Let somebody else kind of waste their time with investments like this, is my point of view. Now, that's my point of view. I'm not telling you to buy, hold, or sell space. You can buy it if you want. I hope you make a ton of money. It's just not the right investment for me. It's giving me red flag after red flag. I don't believe in the business. And those are my comments on that one. So CRM versus Adobe, the battle of two software giants that are really good businesses. Both are excellent businesses. CRM, I just talked about. Let's talk about Adobe. Adobe is the leader in creative software, right? And they continue to grow. They're a big business, $22 billion in revenue, growing at 10.5%. Beautiful cash flow. $9.2 billion free cash. Beautiful green cash. Woohoo! Nice cash flow growth. Look at that growth. Look at that upward trajectory of cash. Why do software companies create so many billionaires? Cash flow. So you're a software engineer. The reason why Bill Gates became so freaking rich from Microsoft and then Adobe and a bunch of software companies, and I would put like Google and Meta, those are intellectual property software companies, right? Is that these businesses write a program like Adobe. They write a program once and they can sell it to 1 million customers. They don't have to recreate it 1 million times, just once. They sell it 1 million times. They make a lot of money, a lot of profit. That's why these businesses are so valuable. 89% margins. That proves my point that you create it once, you develop it once, and you sell it 1 million times. That's why Adobe's so valuable. CRM is very valuable. Microsoft's very valuable. I can go on and on. So Adobe is a very good investment for me. It has a nice low PE, 18.5. Excellent. We saw Intuitive Surgical was like 70, and these guys are growing well. So this is, and the Adobe has better margins than Intuitive Surgical. So nice low PE. I have full valuations for Adobe and CRM. We'll start with Adobe. And Adobe, their cash flows are, if you compare the value of their cash flows versus their current stock price, you're looking at a 63% discount. Cash is where the money's, that's where the value's at. And they have a terrific balance sheet. They have plenty of cash. So just a really sound business. Why is the stock discounted? The whole AI story is Adobe's going to be put out of business by AI. I don't believe that. Their revenues keep growing. So every quarter they're disproving that whole theory. Okay. So Adobe looks terrific. Salesforce looks terrific. Salesforce is a big cash flow generating machine. Again, why is the software business so damn valuable? You develop the Salesforce code, you sell it to 1 million customers. You only had to develop it once. You make lots of money, lots of cash. Salesforce is very discounted. Both businesses, I'm a stockholder in. If I didn't own any shares, I'd be buying both stocks hand over fist. I'm buying Salesforce. It's a more recent investment. I'm buying in shares of Salesforce. I'm happy to accumulate that stock. I think over time, this is going to be worth a lot more. So I like them both. Which one would I pick? I'm buying both. I don't need to pick. I think I'll just diversify a bit and buy both. Which leads me to a related question, which is, Unir, you're a software engineer. So I just explained why I think software businesses are so valuable. And when we talk about a Salesforce and we talk about an Adobe, I believe that those businesses are located right here in the green because they have moats. When you look at Salesforce, they've created such a big customer base, and it's really hard to switch if you want to move from Salesforce to a competing solution. Really hard to move. Customers don't move. Adobe, same thing. There's no alternative that customers can go to. So that tends to hold their clientele. That creates a moat. Really high margins, really high free cash flow. They're leaders in their spaces. CRM's a leader in Salesforce automation, customer service, CRM. Adobe's a leader in creative software. So those guys are in the green. That's why I like both those businesses. Now, you individually, any person that is investing, I always encourage people to consider looking at companies that you really understand. If you work as a software engineer, you will understand software companies and related industries. Obviously, software, you're going to understand, hey, a software company functions this way. You develop software, you license it, you provide it as software as a service, or you may be a platform play, you may be an infrastructure play. You understand those business concepts. You can probably understand a healthy software company versus an unhealthy one. You still have to study the fundamentals. Is their top line revenue growing? Are they profitable? Do they have a lot of debt? Those are still important. It's almost like you're interviewing a candidate, right? You're interviewing a new software developer and you see that, hey, they graduated from a good university. Looks like they have good experience, but you still have to ask really important questions like, how come you keep moving from job to job every 30 days? That's a bad thing. You should be staying at your employer for at least a couple of years, but really we want you to stay at this job for like 5 years. That way, first years kind of ramp up, you get to know everybody, and then you get really productive. We get to keep you for like 4 years. So there'd be important questions like that, or it might be, other things in their background are really question marks. Like, I don't know, they got sued. They got sued because they beat somebody up at work. Well, that would be a problem. They're a great developer, but they got problems. So you're interviewing a stock. You're looking at top line revenue. Top line revenue tells us, do customers like your product so much that they're buying more? Is your product so good that more customers are buying it? It tells us the health of that business. The gross margins. Is your product so good you can raise prices and be really profitable? Is your business so good you drive a lot of free cash flow? Is your business so good you avoid having debt? Those are principal questions that you're asking because you're selecting stocks to put into your portfolio. You invest your hard-earned money into businesses that you want. In my opinion, well, for me, I want stocks to double in value at least every 5 years. I want my money to be invested, and I want my investments to work 24/7 to make me wealthier. To work at night while I'm sleeping, to work while I'm on vacation. I want my money to continue to work. So back to you, Junior, is focus on things you understand, but then you got to get good at fundamentals. If you're a software developer, you can do what I do. You just need to really learn. And like I create these Google Sheets. All these formulas here are based on finance. Okay. Now I have a accounting degree and I have an MBA, and I've worked in the software industry for a long time. These are calculations that you need to really understand. Net present value of free cash flows. If it doesn't come out, like if it doesn't make sense, you got to study it till it makes sense, because you're not going to be a good long-term investor until you understand what I'm doing here. You need to understand. This has been taught for 100 years. Warren Buffett read a book that Benjamin Graham wrote like 100 years ago. This is what he was doing 100 years ago. And Benjamin Graham was very successful, and he taught a lot of investors like Warren Buffett how to invest. So this is a proven methodology for weighing the value of business. It's not going to go away. At the end of the day, we invest in companies to make money. At some point, we will want our money back, but we don't want the same amount. We put in 1,000, and if we pull it out in 20 years, we want 10,000 back. That's appreciation. And it's going to appreciate if this business is growing their free cash flows and their stock price goes up over time. It's not going to go up over time if they don't continue to increase their net worth. Okay. So I'm glad you asked about that. Consider being a paid member of my channel. You can attend weekend sessions. This is what we talk about. I'm hoping that my examples will encourage you to get better at investing, and you develop your process, your methodology. You keep learning, and over time you become just a really good investor. You make a lot of money every year. You can continue to work, and then your portfolio is also working. What's fun is having a portfolio that makes more money than you do working. Wouldn't that be fun? And then your portfolio is working 24/7. It's like a ATM machine for you that you just have it just growing your wealth. So glad you asked that question, and I'm happy to answer it. All right, let's talk about Reddit. So Reddit had a really good quarter. It really had a nice rally, and then it had the rug pulled from under its feet because it was benefiting from the Google search algorithms kind of giving them a lot of user flow. And then the algorithm changed, and voila, sorry guys, but the big gorilla in the space, Google, changed the algorithm. Bam. Oh, that one hurt. And now the stock's trading closer to where it was in October. Now, when I study the Reddit business, let's take a look at it. And of course, we're going to compare it to Meta, because Meta is the example in the space. So Reddit, $21 billion market cap business. We have to pay about 18 times sales. Okay, that's the first red flag. It's above 10. Okay, why are we paying so much for this business? Forward PE, 101. Geez, that's an expensive business. Again, Meta, I pay 24. Meta, I pay 9 times sales. Why am I paying, 18 times sales for Reddit? It's not a proven leader like our friends over at Meta. Now, the growth is exciting, but we just talked about how the flow of users really settled down and their guidance was not as good as the previous quarter. As they get bigger, this is going to slow down. Right now, it looks pretty exciting, I have to admit. 61% looks pretty darn exciting. Free cash flow, $215 million of free cash. It's their first year generating free cash. They had been burning cash for a while. Now they're up generating free cash. So let's say I was really generous and said, I'm going to multiply 215 times 40. Okay. I get to about $8.5 billion of value for the company. And the value of the company or the stock is trading well above that. So Reddit's really priced high. Other examples like Reddit, like Snapchat, they've underperformed the market big time. Instagram or Pinterest, Pinterest underperformed the market. It's really hard to compete against the 8,000-pound gorilla that is Meta. These guys have such great penetration in the market. Advertisers love Meta because Meta is really mainstream. Reddit could be a little niche-y. Like, people go on Reddit and there's some users on Reddit that are really passionate about certain topics. Great. But mainstream is Meta. And this is my biggest investment. It's where I have the most money invested. I'm doing great with the stock. And there's no need for me to invest in Reddit. I've got this sector, this industry well covered with Meta. My second biggest position is Google Alphabet. So I'm good. I'm good in that space. Reddit for me is a big pass. I think it's priced too high. Somebody asked about PayPal versus Block. I think Block is uninvestable. And I'll show you some of the reasons why. I think PayPal is discounted quite nicely because the market sold it off so harshly after we had the height of 2021. It sold it off. Now, over the 1 year, it's up 8%. It's had a big pullback. I've been tempted to buy more shares, but I already own a lot of PayPal. It would be definitely a buy. If I didn't have this in my portfolio, I'd be buying it hand over fist. Forward PE 14. You're paying 2 times sales for PayPal, growing at 7%. It's already a monstrous business, almost $32 billion in annual revenue. And they crank out cash, man. It should be deemed illegal to crank out this kind of cash. This is like Narcos, the Netflix series. These guys are cranking out so much cash. So these guys crank out a lot of cash. They're worth a lot. And I'm going to show you Block and show you how that's a very stark contrast when you compare against Block. And I'll tell you, it'll be obvious why I invest in PayPal versus Block. So PayPal is still heavily discounted because those cash flows, that cash is so sweet and so valuable. It creates a very high enterprise value for this particular company. And over time, the market will weigh the value of these cash flows and will price PayPal correctly. For the near term, there's sentiment out there that's like, well, what's there to be excited about PayPal? And I have to agree that there's not a lot to be excited other than they continue to grow. They're established in industries. Their moats are pretty strong because they're usually, integrated and implemented into so many websites that they're not going to be replaced. It's just going to stick. It's very sticky business. So PayPal is highly discounted as opposed to Block. Block has tried to do some things that are going to be very futuristic, and it followed the same kind of, trading that PayPal had. But this stock has really been punished, down 25%. The market cap to revenue, it looks really good. Forward P looks good. Now let's get into cash. So free cash, this is why I was staying away from Block. It just was a bad situation where PayPal had very consistent free cash flows. Now Block has this really nice cash flow number at 1.5 billion. Let's take a look at the quarterly. So free cash flow is negative. See how this inconsistency, this drives me crazy about Block. Negative, positive, 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 negative. Guys, you're a payment company. You should be more consistent than that. So it's inconsistent, unreliable. I like PayPal. Block has gotten into crypto quite more than PayPal. PayPal is in crypto. But I just like PayPal more. I think it's more consistent, more reliable. I think it's going to reward me, where these guys are just I would say, undependable, kind of stock. And I'm given a choice, PayPal or Block. PayPal. That's where I would go. So somebody asked, why do I invest in crypto? I mentioned that I've been in the software industry for quite a while, and I've been a believer in technology for a long time. It's really, I'm 56. When I was a youngster 30 years ago, and we had the internet beginning to take off, a lot of people were like, oh, internet, that thing's a fad and it's not going to, I thought, no, you guys are wrong. If we get connected, it's going to really change the way we live and we do things. And absolutely, that was right. Now, I believe that we have a fully connected world. We're in so many digital experiences that having a digital currency totally makes sense. So having a digital store of value, that makes sense. So I invested small amounts into Bitcoin, and it's really flourished. It has compounded that investment. I've invested very small amounts and they grew. I was buying Bitcoin in 2018. I think coins were $1,500 or $1,800. Well, Bitcoin now is at $83,000 a coin. So maybe I shouldn't have invested small amounts, huh? But all kidding aside, I'm glad I invested in it because it's been right there with my best investments. My best investment in my investing career has been real estate. I bought at the right time. It compounded because it's a leveraged investment. Second best has been stocks, especially the really big winners. And third has been crypto. Crypto has been a very good asset class. It's a good way to diversifying, but big picture, do I believe in the digital economy? Yes. Do I think digital currencies make sense? Yes. Can I explain to you exactly how, things are going to play out in the digital currency world, cryptocurrency world? No, but I don't need to. I think the store of value story most definitely supports Bitcoin, and Ethereum has a very good network that they're developing. Now, I only invest in Bitcoin and Ethereum, the two most dependent on trusted coins out there. Other people invest in the altcoins, and that's their approach. I don't touch that. I play the crypto investment just to have some money out there. It's been good so far, and that's why I invest in it. All right, so we're going to hit TSM, and then I'll catch up on those comments. Thanks so much for joining. We are still 23 strong on the live stream. Thanks for hanging in there with me. Thanks for hanging with me on a Friday night. Friday Night Lights. It's like a nice, good football game. All right, so TSM's been a superb stock. I owned TSM for a long time. I made a lot of money on TSM. I really like TSM. It's been a superb company. I own the stock and I sold it around here. I made lots of money on it. Thank you, TSM, for that money. It really came back down and it's really flourished in the whole AI build out. But I think the stock is priced too high now. I think the stock over the past couple of years, it's run up about 200%. And when you look at the 1 year, it's 26%. But geez, you're going to lap this compare, and it's not going to look as good pretty soon. Once we get into the June timeframe, the stock is going to show that it's not doing all that great. And when you compare TSM and you look at their fundamentals, you have a stock that's $88 billion in revenues. So you're paying about 9 times revenue. That's not a problem. Forward P is 19.5. Not a problem. That looks fine. The company has had, this is a cyclical industry. They had a pullback, and this is going to be in the Taiwan currency. So I'll have to show you the US dollar amounts. When we look at the US dollar amounts, cash flow, 26 billion. Okay. So when we look at this business, I'm a little apprehensive about semiconductor. I think it's had such a run up that it's going to have a lot of sell-offs. I don't need to convince anybody of that. You look at Broadcom, Nvidia, TSM, you look at Marvell, boy, they're getting shellacked. So I think these guys are going to have some headwinds, and their growth is going to really begin to falter. Now, if I look at a $26 billion market cap number, I might multiply that times 20 because they are growing really nicely. I'm not completely confident in the space. I get to like $530 billion of market cap value, but they're well north of that. And I am just really concerned that, hey, they're not worth 763 billion. They're worth about 200 billion less. And I think there's going to be a pretty good haircut in the future. That's how I feel about it. And we'll see how things play out. One thing I wanted to check is I don't think they have debt, but let me double check. Yeah, they do have some debt, but they have more cash than debt. So they have plenty of cash, more cash than debt. So that's TSM. I really like the business. The same thing with Broadcom. I made money on Broadcom. I sold it. I think Broadcom's too expensive. And I think Broadcom is probably more priced way too high, or I think the premium on Broadcom is much higher than on TSM. So we'll see how things play out with semiconductor, but it's been a painful ride for investors. Let's take a look at the year to date. These guys are down 11%. Is this stock going to work anymore? You see how it's kind of flatlined here? I think the stock's going to continue to get punished. I think it'll continue to come down, maybe down to 125 a share, because the storylines around semiconductor is the stocks are priced too high. There's probably more reasons why you're going to see economic headwinds for semiconductor going forward than really big tailwinds. You're seeing the big data center build outs really slow down. So I think TSM is going to have a hard time keeping their stock price where it's at. I think it's going to come down going forward. So that is TSM. All right, man, you guys are making me work tonight. I've covered 2, 4, 6, 8, 10, 12, 14, 16, 18 stocks. And we've got into some pretty good detail on them. So thanks for attending. I am going to take a look at the comments, and then I'm probably going to shut this down because I got to go eat some dinner. Let's take a look here. Omar, good to see you, man. Would I buy a Rivian vehicle? No. I think Rivian's interesting, but no thanks. I'd rather buy I guess $100,000 vehicle. I'd rather buy $100,000 in a cool stock. I kind of lived through my cool car phase. I used to collect cars. I used to collect classic cars, and I sold them all, man. It was a little too much maintenance. I did enjoy owning them. But I checked the box and I had the experience, and I'm done. Now I bought my wife a really nice car, and we drive around in that car, and I'm good with that. I'd rather have experiences going forward, and I'd rather just see my portfolio flourish. That is fun. It's a lot funner than owning classic cars. All right. DC devs, in terms of revenue, would say it never really got off the ground. So I'm not sure where I can place that comment. Sorry. Tom Cantor, good to see you, man. The whole tariff thing, it's going to be an up and down, kind of depending on how the market's feeling that day. Once we get tariffs completely out of the news streams, it's going to be a good thing. Just let companies kind of operate without that being a lever. I think that'll be good. And it will get there eventually. All right. And then yeah, Unir, thanks for tuning in, and appreciate your questions. Yeah, guys, appreciate the comment on dinner. Hey guys, consider being a member of the community. You can get more details on my channel. Let me go over to that, kind of show you where to get signed up. Some people have asked recently. We've got some new members, which is cool. Thanks so much for tuning in. So my channel is Victor H Investing, and you can find me at Victor H Investing. You would basically go right here, click join, boom, you join the community of people. There's 3 levels, and I think each level is worth it, depending on what you want to do, the amount of time that you would need. And I really encourage you to do that. You would get access to the tools that I use, like the Google Sheet I created here. This, you get access to an example model. And then I publish all the valuations that I've done once a month. Not meant to be financial advice. It's just to give you examples of how I do things. It's almost like, Benjamin Graham wrote a book way back when, and people would view it, and then they would take that work and then create their own. And that's what I hope you do with these tools. You get access to them if you become a paid member, and you come to member only calls where we really slow down and really talk about topics, make sure that each investor's getting better at investing, maybe getting differing viewpoints on how to look at certain fundamentals. So consider it. I'd really appreciate it. And again, you go to my YouTube channel, you click on this guy, and then you get all signed up, and 3 pricing levels, and I appreciate it. All right, guys, it's been an awesome stream. It was good to have a positive week. Good to be a positive week. And let's see what happens next week. And hopefully we get a little bit of rally. I am beating the market this year. I'm in the green this year, which is a good victory, man. The last 30 days or so, about 30 days, it's been a little rough, man. Some days are just horrible. So it's good to be on top. And I hope to make some money in the remainder of March. And I'm setting myself up to have a very good year. And I hope you are in the same position. Everybody, have a terrific night. Have a good weekend. Let's do some good analysis over the weekend and take advantage of the market, because there are some really good buys out there. Stocks are being discounted because the market's selling them off. All right. Well, thanks for tuning in. Everybody, take care.